Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at a vol capture trade, an Iron Condor trade on Marvell Technologies, MRVL, where some massive repeat unusual option activity spikes IV to by far the highest levels ever seen, setting up ideally for a vol capture trade with risk defined but with huge edge, taking advantage of the highest IV ever with an Iron Condor. So let's jump in and take a look. We always like to, as always, use our fusion approach, right? Take a look at fundamental, technical, and in this case, especially implied volatility analysis. So here was kind of the news on Marvell coming out a few days back, where Jensen Huang from NVIDIA called Marvell the next trillion-dollar company, right, at the Computex 2026 show, right? That sparked a huge run-up in Marvell shares, which absolutely ripped higher here since the beginning of June, right, to over 300, and basically has put the capitalization of the company over $250 billion, right? Of course, NVIDIA benefits from this, right, because they have a $2 billion strategic investment in Marvell. So certainly Jensen, the CEO of NVIDIA, has a good reason to be saying that Marvell is going to head a lot higher, right, because the company has that massive stake. Always important to remember that. Scanners, here's the scanner from basically Tuesday's close, right? You can see Marvell seeing massive unusual option activity, over 3.5 times the normal volume, right? You can see that the implied volatility level at the highest level ever, right? At 100% over the past year. So certainly unusual option activity. The stock moved from 290 to over 300. Then we saw yesterday, right, the same sort of huge unusual option activity, another almost 550,000 contracts trade, almost 4 times normal volume, and a new high in IV, right? We're seeing the stock move from just over 300 to 316. Valuation certainly getting stretched as well, right? So the scanner's pointing out some unusual option activity. This spikes that valuation. Here is a 20-year price to sales chart for Marvell. You can see trading now over 30 times price to sales, right? A 6-month PE chart can see that the PE is now well over 100, and this is after earnings have come out and been factored in. So certainly valuations going to the moon as well. Implied volatility, absolute moonshot too, right? Here's the implied volatility. I took the 90-day over the past year. You can see just that big rip higher over the past several days ever since that announcement, right, that Jensen Huang thinks Marvell is the next trillion-dollar company. Everyone flooding in, believing it, right? You can see the whole term structure of vol lifted. Interesting to know, right? Here's the earnings, right, that came out, the normal vol crush post earnings, right? We'll take a look in a second on the chart here. So the vol went from just under 100 back to 82, the normal vol crush, which earnings comes out. But now we're seeing that vol rush on that announcement, right, that Marvell is the next great thing, right? So implied volatility just going through the roof. You can see the September IV moved up over 5 vol points, right, on Wednesday at the 100th percentile. Never been this expensive. Here is a 5-year chart of IV, right, of a basic 25 delta 90-day option. You can see it has never been close to this ridiculously spiked area over 110 IV, right? All because of the AI and then the Jensen Huang news that Marvell is the next greatest thing here. So at some point, right, we're going to get a reversion back. Taking a shorter look at it, a 6-month look at this chart, same chart here, but I added also the basic 25 delta put. You can see both calls and puts ratcheting higher, but the calls far outpacing the puts. Speculation on the call side, everyone rushing in, paying whatever they really don't care what they pay for the calls. We're becoming willing sellers of that whenever we see this sort of huge spike. But we're a day early. We actually got into the trade yesterday morning. You can see it headed even higher yesterday, right? A new high in IV on the 90-day. That lift once again, right? We're seeing that September moving up another 5 vol points. You can see out of the money calls still trading at a massive premium to the out of the money puts. And now we're trading at an even higher IV level, right? Here was the earnings, right? Just under 100. Now we're pushing towards 110, even though earnings came out, right? IV still at the 100th percentile. Here's that chart of both the puts and calls on a 6-month basis, moving higher yet again. But at some point, trees don't grow to the sky forever. We'll see that start to soften, which I think will be very, very soon. So that's set up ideally for kind of a neutral trade. Here was a trade I did basically yesterday right after the opening, right, which was going out selling the 400 410 call spread and the 200 190 put spread in September, right, getting $4.71 for that, right, getting over 100 IV, as you can see here on the trade. So able to sell over 100 IV on the trade. Stock was right around 309, 310 at the time. So our max gain on the trade, 471. The max risk, right, 529. So our potential return, 89%. The upside break even simply 400 plus the credit, or roughly 404.70. The downside break even 200 less than that credit, 195.30. So 95 points plus of upside from where the stock basically we put the trade on around 310. Over 110 points of downside cushion, so we have 30% plus upside cushion on the trade, over 35% downside cushion on the trade. Really just looking for that IV, right, which we have seen has just shot to them to revert back a little bit, right? You can see on the chart here, the stock finally starting to show a little bit of softness, right? We put the trade on this day, right? We actually saw the stock up again a little bit yesterday, but shares trading at a huge premium to that 20-day moving average, the biggest one we've seen over the course of the past year. A 9-day RSI pushing towards 90, MACD, the highest level of the prior 12 months by far. Bollinger %B, which is implied volatility base, still well over that 100 level. IV, as we said, the highest level of past year, the highest level ever. We don't mind selling the highest IV level ever and doing it in that defined risk Iron Condor fashion. So here's basically our trade, right? Selling the 400 410 call spread, the 200 190 put spread. So basically about a 50-50 proposition. Plus you have all these shorter term weeklies, right, to continue to hedge, to chop wood, as I call it, all the way out to September, selling in case the stock continues to rip higher, selling some out of the money put spreads the further ahead, rolling up that put spread. You got all these weeklies, so you can certainly continue to bring in more premium, chop wood, as I call it. So like the trade on that front, especially if IV stays elevated, which I doubt it will for very much longer. Did a quick little Theo here on the trade. So I basically pulled off that the call spread where it closed at with the IV 197. If we drop it 5 vol points, it drops 2 pennies to 195. But the put spread, if we drop the IV just 5 vol points, drops from 278 to 260. So a 5 vol point drop in IV, not a big one, right? We're only looking for IV to go from that 110-ish level, right, down to 105. Now looking for it to revert back to here, which would be a much huger benefit. But even that sort of move gives us a 20-cent edge on the trade. We have huge positive theta because of the high IV as well. So I like this on all fronts here. Selling a stock that is certainly overbought in a huge way on a technical basis, about the most overbought it's been over the past year, right? Certainly overvalued on a fundamental basis, right? Price to sales over 30 times, right? PE now over 100, even after earnings came out, right? Just because of the massive run up in the stock, all because of the CEO of NVIDIA calling Marvell the next great thing. So we have no problem at all taking advantage of that huge lift in implied volatility, just looking for it to soften. I'm sure we'll take this trade off as soon as it does and realize a nice gain. So that identifies how we go about identifying opportunities here at big time options, where we find the edge, then put on the hedge. But as we always like to say, trading is all about probability, not certainty. Make sure you position size accordingly. In this case, we have that defined risk trade. And this one, as we know, sometimes you just got to say, what the, from risky business, right? We know this will end badly, right? You never get this kind of spike in IV lasting too long. It always comes crashing to earth. Then we have plenty of time for it to happen, and we have plenty of ability to re-hedge it. So until next time, as always, here's to good trading.